Hello, hello. Today I have another case from stage 2 of the Financial Modeling World Cup. This is the medium level case called Organic Growth. Let me read the story for you here of this case. Jane has a new business idea for a specialty souvenir store, Jane's Souvenirs, or JS. She has accumulated $200,000 in savings to invest in the business. Jane wants to start with one store but later expand it to a whole retail network across the country. Jane is very conservative and risk averse. She plans to finance expansion only from the profit accumulated by the business. No bank financing, no investor money, only accrued profits will be used by Jane to grow her business. I'll get into the details of the financial model when I start solving the case, but if I go back and look at the file, what we have here in our list of assumptions, we have some general assumptions, sales, general and administrative assumptions, store data for investment, and store data for operations. So if you want to give this case a try for yourself, check it out in the description. I have a link where you can purchase the case. You can get the file with all of the questions. I have put the questions up here. Let me just zoom out a little bit because you can't see all of the options. One quick note, by the way, on these questions here, you'll see that I have question 9 and 15 highlighted in yellow. And that's only because when I did this case live, I got these two questions wrong. So I have got to do a little bit of practice since then. I'm hoping that now I can get these questions right and I should be able to solve the whole case. So stay with me. Let's see how to walk through this case. I'm going to start my timer here, and here we go. All right, so your goal is to create a high-level financial model for Jane's business and to answer the questions. It will be enough to create a 10-year monthly model that accommodates 10 retail stores. So I'm going to do a 10-year monthly retail model. So what I'm going to do is, let's see here. Let me bump up the font a little bit because I think a 9-point font is going to be hard to see. Let's do 14. All right, so let's do period here. And I like to go in the 5th column here. Now, we're doing a 10-year monthly model. So I'm going to do 120 columns. I'm going to add one more and start at 0. So that way, when I start putting my formulas in column number 1, they can go back to reference column number 0. Now, do I have here when the model starts? Yes, it starts on January 1st, 2025. So let's put start date. And let's put, let's see here, how can we do this? E-date. Actually, no, I don't need to put this in a date form. I can just put it like that. And then for the number of months, I'm going to go this array minus 1. So if I do that and I change these to date format, then I'm going to get all the dates here. Awesome. January 1st. That's what I want. All right. I'm going to do also a trick that I learned from DIM, which is to hide all of these extra columns so that when you do control right, that just takes me to right to the end of the model. End date is going to be simply that. Okay, so this is an interesting thing. It should work normally, right? It should just go cell by cell. This one doesn't. When you give Excel some encouragement saying, good job, Excel, give it a plus sign, it somehow magically works. Don't ask me why. I've just learned that from other videos. All right, now since all of these periods differ by a year and date, I'm just going to put year, date. And then for year, okay, and then not date, that should be month. Awesome. All right. So let me go ahead and freeze my panes here. There we go. All right. So model start date. Annual inflation 3% kicking in once a year on January 1st. Okay, so let's get it. We're going to do inflation index. And I believe I can pick this up from here. Yes, I can. Oops, 3% there. So what I'm going to do is I'm going to put 1 plus this percent here. And then we're going to go to the year. And since year 2025 is going to be 0, I should be able to put that just like that. So when I do, All of 2025 is going to give me the inflation index of 1. I'm going to do 4 decimal places. There we go. So 2025 is all 1. 2026 is 1.03. That's exactly what I want. Assume that all cash flows happen on the last day of each month. Okay, income tax rate is 20%. It's paid once a year on December 31st based off of the profit of the calendar year. Okay, we haven't got to tax yet. Tax losses are not carried forward. Also, in case of losses, there is no tax rebate. Okay. And then we have an enterprise value. So this stuff will probably come back to later. All right. Use the following assumptions for each new store. Each store will require a 3-month lead time. During these 3 months, the construction works will be completed and the stock of goods will be supplied. Each store requires $100,000 of capex investment, furniture repair works, and $20,000 of investment into the initial stock of goods. Assume these amounts are paid in 3 equal installments during the 3 months of lead time. All right. Does this say? Okay, the first store construction started on January 1st, 2025, and it will be open for operations on April 1st, 2025. All right, so let's do start construction. And we said here, I'm just going to put a 1 there for now. And let's do store under construction. And then, so if any of these three are 1, that's the store construction. So, or, okay. And then, let's just check. So if I go through there, all right, we get a false there. I'm going to turn these into 1s or 0s. Awesome. And then let's go to stores in operation. So, stores in operation will be any store from 3 months prior. So I'm just going to do sum of that number there. So there we go, 1 store in operation there. And I believe I can go back and those will say 0. Good. Now while they're under operation, let's do capex. And there were 2 types of capex, right? There was $100,000 of capex investment, and $20,000 into initial stock. Okay, so capex investment, stock investment. So are those 2 numbers here? Yes. And this is going to be annual, and that's going to be monthly. Okay. And those are going to happen when the store is under construction. And I do believe, right, so inflation needs to be applied to them. So, all right, so with capex, so what we're going to do is it's going to be monthly amount times the inflation index. Actually, I could start it back there. I'll start it back here. Monthly amount times the inflation index times anytime the store is under construction. So those should say 1. All right. And then I can do the same thing down here. If I do that, is that going to work? That does work. All right. All right. So there's how we're going to get the capex and stock investment. All right. Let's see here. The next store's construction will start in the next month after the business again accumulates at least $200,000 in cash. Okay, so we haven't modeled equity yet. However, no more than 1 store can be under construction simultaneously, even if there's enough money for 2 or more stores. Capex is subject to straight line depreciation, assuming a 7-year useful life. Remember that according to accounting rules, depreciation calculations start from the next month after construction is completed. Okay, so let's do depreciation. Let's say starting base plus capex investment. How long was the depreciation? 7 years. And since we have a 10-year model, that means some items will come out. Let's say remove from base ending base. There's probably a better way to word that, but okay, so ending base for year 0 is going to be 0. Starting base is going to be that. Capex investment. So if there's a new store in business, so that isn't greater than that, then we need to sum the previous 3 years capex. So 1, 2, 3. That's not going to be added in, so that's going to be fine. Oh, I didn't write the word if. Huh, there you go, Ben. All right. And then remove from base. I'll take care of that in a minute. Okay, so put all of these as currency. And then if I go ahead and copy these over, why is my computer not responding? Okay, come on, Excel, this isn't that much. I don't want spark lines. I don't want any of that stuff. Honestly, part of this happens when I'm recording. I think OBS takes up a lot. I need to check settings. I think someone has settings to make it lighter, but I need to find those. All right, I have a feeling I'm gonna have to pause this. Let me pause this and try to get this sorted out. Ooh, that's not looking good. Okay, I think we're back now. So this is where I got. Let me turn all the save off. I'm probably gonna regret that, but oh well. So this plus this minus that. Let's turn all of these to currency. And if I go ahead and move that all to the right. All right, but the concern here. Oh, that shouldn't be by 12. That should be by 3. Right. Okay. And let's fix the width of these. So that should be, let's set it to 16. Actually, let's set it to 20. All right, $100,000. That's what I want. Now, it's a 7-year depreciation. So since this starts in period 4, I'm going to take it out in period 88. So let me just scroll over to period 88. And if I take this out here, let's see, 4, 3, 2, 1, that's fine. Move it over to there. Now my depreciation base is 0 for those extra years. All right, good. All right, and so let's see, depreciation amounts. Do I have 7 years in here? Yes. Okay, so years, months. Now this I can do by 12, yep. And then what I can do is take all of that divided by 84 months. There we go. All right, depreciation is in there. All right, let me go back to the instructions here. Oops, there we go. All right, so that's mostly taken care of. Operations. For the purpose of the model, let's assume that all stores are identical and operate according to the following assumptions. Each store is to generate $30,000 in retail sales every month. This is after the average discount of 5% given to clients. Okay, so let's call this investment, and let's go down here and let's call this operations. So revenue less discount and net revenues. Okay, so net revenues is going to be the 30,000. Okay. So that means the gross revenues. Let me just see if I do my math. So if I do that divided by 95%. Okay. That times 5%. Yes, that matches up. Okay. So what I'm going to do, it's that amount of money indexed to inflation per store in operation. So I'm going to take that times our inflation index times how many stores we have in operation. Now I know I'm going to have to increase that later. I'm not worried about that for now. Less discount. So that should do that there, right? And maybe I should be safe and just say this minus that. Oh, that's interesting. Oh, that's because, wait, no, that is interesting. Okay. All right, there we go. Okay, so here we have $30,000. When I expand that more, that's going to be another $30,000. All right. Additionally, December sales will be 2.5 times higher due to seasonality. All right, so I'm going to add up here. Let's see here. Seasonality, and that's going to be 2.5. There. Okay. So we're going to say times if the month is equal to 12. I'm going to add that factor in. Otherwise, just keep it at one normal multiplier. You know what? Let's carry these over. I'm probably going to regret this, but I just want to see, is December calculating up right? Yes. Okay, we're good there. We're good there. Okay. Product average markup is 3.5 times. Also, the average discount given to clients is assumed to be 5%. Okay, we already got that. Use these numbers to calculate the cost of goods sold. The inventory will be restocked and paid for the same month it gets sold. For simplicity of calculations, assume that a store's inventory does not change in dollar terms, so store one will always have $20,000 of goods in stock despite inflation. So I'm guessing what that means is the cost of goods is just going to replenish that month's inventory sold. So if I put cost of goods sold, so it said average markup is 3.5 times. All right, let me do some mental algebra here. So 30,000 is 3.5x divided by 30,000 divided by 3.5. Okay, so markup is, how much is markup? I should have that here. Yep. Whoops. Markup is there. So if I have that right, that could divide by 3.5, and then I can get cost of goods sold. And just to check. Yes. Okay. Cool. Each store will employ salespeople in the amount of 2.5 full-time equivalents. 2 people work full-time, 1 person will work part-time. Okay, so full-time equivalent employees. So this is 2.5 per store. So we just need to take number of stores in operation times 2.5. Easy enough. Okay. Oh, that's not times. That's times. There we go. 2.5. All right. And then FT salaries. So this is $50,000 per year, which is that much per month. So that times this, and I'm gonna guess that's indexed to inflation. It does not say. I mean, unless I'm all the expenses will increase by 3%. So yes, indexed to inflation. So let's get that inflation factor in there. Okay. There we go. All right. And that's that month per month. Okay. Let me move that down just so that it's in the same line. Okay, cool. So that's FTE salaries. What else do we got? Each store will have an area of 40 square meters. Rent expense will be $30 per square meter per month, while utilities will be $10 per square meters per month. So floor space, and then do I have 40 here? Yes, 40 per store. So we're going to take that times number of stores in operation there. And then what was it? Rent expense will be $30. Okay, so rent expense is $30 per square meter per month. So that's probably going to index to inflation. Yep. So we got to get our inflation number in there. All right, and then use utilities, which is in there. Oops. So once again, times inflation. All right, good. Okay. other costs will be $1,000 per store per month. So I guess we'll just list this as other costs. We have 1,000. Yes. Per store per month. So this times number of stores in operation times, once again, inflation. Okay. All the expenses will increase by, okay, yep. During store lead time, oh, GS will have to bear all the costs except for the rent. Okay, so these are not just for stores that are in operation. These are also stores that are under construction. So, oops. Stores under construction or in operation. And basically, what I'm just going to do is that. That should do me well. All right. So, does that mean all of these? Yeah. Okay. So salaries, it depends on this one, which that depends on this number. Okay. Floor space depends on that number. Utilities expense. Okay, that's listed as floor space. Other costs is related to that number. Rent is not. Okay. Okay. So let's do floor space for rent expense. Let's do floor space for utilities expense. And then so utilities is going to be based off of this number. Rent is going to be based off of that number. There. Okay, so Yep. Okay, that all lines up, I think. Numbers are kind of a mishmash, but oh well, it's gonna work. All right, sales, general, and administrative expenses. So, what do we got for that? At least one administrative employee is required for 2.5 stores rounded up. So, administrative employees. So this is 2.5 there. Stores per employee. Okay, and that is under construction or operations. So we're going to go off of this number divided by that, and we're going to round up. So that is one. Yep. Okay. Administration employee salaries will be $60 per year. So admin employee salary, that's $60 per year, which is per month, indexed to inflation, I'm sure. So that times this times our inflation. All right, and then other SG&A expenses will be $1,750 for each store in operation or under construction. So, other is this. So that times this number times inflation index. All right. All right, now keep in mind I haven't done the model for when the new store's coming yet. I'll get to that when I start to model owner's equity or cash balance. Oh, we're at the end. Okay, so now I'm going to model the owner's equity. And I'm going to guess this is on a cash basis. So, all right. Right, I need to do a few things here first. So, net revenues minus cost of goods sold is going to be, you know what, let's just do this. Net revenues, cost of goods sold. I'm just going to bring these down here because, again, it's a mess. Cost of goods sold is there. Okay. And then I'm going to take out SG&A expenses. Actually, no, let me do indirect costs. So rent expense, utilities expense, other costs, SG&A salaries, other SG&A expenses. Right, okay, so rent expense, that is this one there. Utilities expense, there. Other costs, and then salaries and other expenses are there. So that should be able to get me to my EBITDA or EBITDA. So that should be net revenue. Let me just mark this again here. So that minus all of these other expenses. Okay. Right. Makes sense. Okay. And then let's see here. Depreciation expense is what we've already calculated up here. So now we can get to EBIT. So that is that minus that. Now we have the EBIT. Now we can do taxes. So taxes were, where's taxes? I think it was 28%. There we go. So there was 28% per year, and they're only paid in December. So if this month is December, I want to take the sum of that EBIT where the year is referencing the current year. So let me lock those ranges in. And then we're going to multiply that by the tax rate. Can I take this as a range? I actually don't know. Let's see. I can. All right, good. Okay. And then we can get net income. Awesome. All right. Whoops. I don't want the underscore. Oh, well, it's already there. Too late. Okay. So now let's model the owner's equity. Starting cash balance plus net income. Now everything in net income here was all cash based, meaning all of these dollars amounts actually involved money changing hands except for depreciation. So we're going to add that depreciation expense back in, and that should get us our ending cash balance. So this we're going to just put in the amount that we started with, and then here we can put in our formula. So there, net income is going to be there, depreciation expense is there, and then the ending cash balance is going to be that plus the net income plus the depreciation. All right, and then I could take these four and move them over to the right. Now Oh, wait. Less investment expenses. These up here. Right. Is it $40,000? Yes. Okay. So that needs to change up a little bit. Minus that one. All right. Okay, now that I've got all that in, I believe the last thing I need to do is just model when the new store starts construction. So, we can't construct on 2 stores at the same time. So both of those should equal 0. Actually, let me put it up. I think I can put it here. So the 2 previous years should equal 0, and the ending cash balance from the previous month is greater than or equal to, let me check again. $200,000 in cash. So we're gonna put $200,000. We'll set that to turn a number. Right, so that's gonna be 1. These should, I was worried about that. Circular reference. All right, I'm going to do something that a lot of people are probably not going to like. I'm going to turn on iterative calculations. Now, if I move those over to the right, and then I can also move these over to the right. Okay. So I got some 1s in here. Things seem to be lining up. All right, then let's see how well I can do with the questions then. So, what are JS sales before discounts in April 2025? So April 2025 here. Sales before discounts is that number. Whoops. 31579. All right. What is JS's cost of goods sold in that same month? I gotta stop alt tabbing because that's not how this works. Cost of goods sold there. 9023. All right. What is JS's payroll expense for store personnel in January 2025? So January 2025 is there. This should be the right number. 401-10417. All right. What is JS's payroll expense for administrative personnel in January? Let's see. Administrative salary in January. That should be this one. 5,000. What is a rent expense in April 2025? So we're going to April. We're looking for rent. That is here. 1,200. There we go. What is JS's EBITDA in January 25? So go back to here. EBITDA is negative 7750. Oh boy. All right, that's not lining up. Let's take a closer look here. All right, so we have these costs. Oh, why is that not taken into consideration? Yeah, that's not in there at all. All right, full-time salaries. So that should be in this row there. Now when I go back and check this formula, I need to add that in, fill that over to the right. Now I get 18,167. Is that an option? No. All right, let's look again. So we don't have rent, we have utilities. Why isn't utilities adding up here? Because utilities should count. Oh, I bet what it is. Yep, there it is. All right, now what do we get? 18, was it EBITDA, right? Yes. 18,567. that is an option. All right. What is EBITDA in April 2025? So that will be here. Okay. All right. EBITDA for the year 2025. Okay, so I'm going to sum the EBITDA, whoops, where the year is 2025. I get a negative 10,968. That's not matching any of the options. All right, let's take another look here. So it's this line we're adding up. I'm just gonna check the math myself. 10,968. Right, okay, so let's see if we can figure out what's not. This we checked, this we checked. Is depreciation. Wow, how am I missing all of these very important things? If I put depreciation expense, oh no, that is in there. Depreciation is in there, that's down here, okay. That's fine. Then, let's see, so rent starts there. And rent was, okay. Yep. Other costs of $10,000 per store per month. That's also down here. SG&A salaries and expenses, that's down there. Oh, wait, whoa. Is that might actually be right. Yeah, that is right. I don't like how I have that laid out, but that is right. Yep. And then that should be the difference of those two. Yeah, okay. Salaries I got in. So I got cost of goods sold, I got salaries. Administrative salaries down there, sales, yeah, why? Alright, let me just check the question again. Every time for the year 2025. Okay, let's take a look. What am I missing? When I get that December bonus in there, yes I do. Yes I do. No, wait. Okay, here we go. That discount should be higher for December. Okay. Why is it not? Oh, I see. There we go. All right, now let's check December again. So December should have a higher. Yes, it does. Go back to this sheet. 13,337. Now we match up. All right. What is JS's EBITDA for the year 2026? So I can use this same formula here. Now I should be able to put 2026. 47375. That lines up. Number 7. Number 7, I didn't check an answer. 1211. That's this one here. Okay. What is JS's cash balance at the end of March 2025? So we're going to look at March 2025 ending cash balance 24,300. There we go. What is the depreciation expense in April 2025? So April 2025 depreciation expense is there. 1190. Okay. What will be the tax amount paid in December 2026? All right, so let's go to 2026 December. That's here. The tax row is there. That's not comforting. I don't think that's going to be one of the answers. No, it is not. All right, let's take a look at this one. What is going on here? Okay, I think, yeah, that's what's wrong. So I do believe if I do that, now we go to December 2026. I have a number here. Okay. 9265. There we go. When will JS open its second store? So basically what I'm going to do is I'm going to look up 2 in the stores in operation row and return the date. Let's see here. That's November of 2029, not on the list. All right, so I'm glad these options are here because it helps me check. So according to my model, that's when the second store opens. That's when construction starts, because that's the first time we had 200,000. The question is saying it shouldn't be until 2030, so it should even be a few years later. All right. Then let's take a look here. Let me see. Okay. Yep. That does not get adjusted for inflation. No, because the depreciation base remains the same. So that should be fine. Okay, I see now. Alright, and that's when starting base, okay, yep, ending base is there, yep, okay. So, let me just take a look here. So that's being adjusted for inflation because that's over 30,000. That number is copying down there. Cost of goods sold is happening accordingly. There's net revenues. Full-time equivalent salaries is lining up. Rent expense. It is accounting for inflation, which I do believe that is the case. Yes. All right, utilities expense, also accounting for inflation. Other costs accounting for inflation. SG&A salaries and other expenses accounting for inflation. Okay. That should be working properly. All right. So this is too early. That's the problem. That is too early. Just gonna check. Okay, yep, that's all lining up. All right, why is that too early? We need to take a closer look here. That's making sense. I don't like that it's out of order, but it's making sense. Is that the taxes? Oh. How did that... Hold up here. How did that turn out to be a negative number? It's... Wait, what? That shouldn't be a negative number. Oh, wait, I know why. Because there's a floor. So it should be... They don't ever go into... Oops. And that's the problem. That's the problem. Okay. Does this work? I have no idea if this is going to work. I think it did. So in December... Yeah, that actually did work. Okay, let's see here where they did pay tax. Yep. Okay, now. I get April 2030. Okay, so that was the problem. I forgot to set the floor for the tax. How many stores will JS have after 10 years? So at the end of the model, we have 8 stores. There we go. What will be JS's net profit in 2034? So we'll do another sum. We'll go down to net profits. We said 2034, right? 371,770. There we go. And at what month will the value of the company surpass 1 million? I didn't do valuation yet. That was towards the top here. JS's enterprise value is calculated as last 12-month EBITDA times 7. All right, so let's go up here. Let's do last 12-month EBITDA. What I'm going to do is I'm just going to start with this. Let's see, EBITDA is up here. And enterprise value, which I'm going to pull from here, I believe, 7 times 12-month EBITDA. So I should probably do that, but oh well. There, fine. All right. Whoops. 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 There we go. All right, and then we need to look up 1 million in this row, return from this row, and it can be the next larger item. So we turn that into a date. We get February 2031, and there we go. All right, a 45-minute solve. There were a few hiccups here and there. But yeah, I'm glad that I'm able to find the answer for these two. I'll tell you what really tripped me up when I did the live solve was the depreciation. So it had 7 years of depreciation. I didn't take into consideration when the depreciation would be pulled back out. So basically, if you remember, when I went to period 84 and I added, let's see, where's depreciation? And remove from base. Okay. Oh, 88, sorry. So this here. So I didn't take it out of the base. So really, I was depreciating CAPEX longer beyond its expected life. I think that given the way that this model is set up, is that the only one? That is the only one. Very interesting. All right, well, I hope that you enjoyed this. I hope that you got something out of this. I hope you enjoyed watching me stumble through a medium level financial model case. I bet you probably next week I will upload the advanced level financial model case if I can successfully figure out how to solve it. If you enjoy these, most of my content, I usually feature Microsoft Excel World Championship, which is much less finance focused, but I do join this competition as well. And so I upload these videos from time to time here. Thanks so much for watching. Give me a subscribe if you enjoy this, and I look forward to seeing you for the next video.
It's the Excel world.